Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We talk a lot about investing in Australia and the US and Europe, particularly the UK, but today we're looking in a different direction, more towards Asia. BlackRock's chief investment strategist for Asia Pacific is Ben Powell. He's normally based in Singapore, but he's in Australia for a few days, so we've grabbed him for a chat. Ben, welcome to Fear and Greed.
Great to be with you. Great to be in Australia. First time in 2 years, so looking forward to it.
Mind you, your job, I'm sure you travel a lot, so the pandemic would have stunted that somewhat, which would have been good, but it must be nice to be back out and around the place again.
That's true, yeah. So normally, in the old days, travel was kind of the norm. For 2 years, my wife and our 4 children have been in Singapore. Singapore's a great place, for sure, but seeing something a bit different, just walking the streets of Sydney, Circular Quay, cup of coffee, has been fantastic, and looking forward to a bit more of that in the weeks and months ahead.
Okay, before we look at Asia specifically, I just want to get your take on the global state of play. So let's start with inflation and US interest rates. In a thematic sense, how are you thinking about price rises globally and then central bank monetary policy with obviously the Fed leading the way?
Yeah, so I think this is the main focus for many investors all over the world. So a couple of things to say. Firstly, we at the BlackRock Investment Institute, our diagnosis of inflation, obviously very high inflation currently, like 40-year highs, it's being proportionately caused by supply factors. So semiconductor shortages, port congestion, obviously a particularly horrendous acute example in Ukraine, currently vis-a-vis energy. So it's the supply side that's driving it. So we think actually as COVID hopefully recedes more and more into the rearview mirror in more and more economies, that should allow supply chains to kind of free up, as it were. More goods can get to more people a bit more straightforwardly, a bit more easily. So that should see inflation come down, still probably at quite high levels, but come down from the extremely high levels currently. So given that, given our diagnosis of inflation is it's kind of the supply side that's driving it, we think there's only so much even the mighty Fed can do, right? The Fed can raise rates a lot or a little bit. That's not going to impact semiconductor shortages, port congestion, and so forth. So where do we end up? We think the Fed is currently unrealistically hawkish. We don't think they're going to be able to achieve their dots. We're a little bit dovish. So that leads us to a kind of still quite constructive overall risk framing, which I can get into if that's helpful, Sean.
Well, yeah, I mean, it's interesting that you are probably not among the consensus there because although probably the last week's a fair bit has changed with people's view of the Fed, but many people have been very critical of central banks for not moving fast enough, particularly here in Australia. I just kind of want to move on to the energy. You mentioned energy there. How does energy fit in to the puzzle at the moment? Is that just supply side? And if so, it could be a long-term supply side issue though, couldn't it? Because of the war in Ukraine, Russia.
It definitely could. A lot in that short question. So it's going to persist, we think, not least obviously in the short term with the situation in Ukraine, but over the medium and even long term, we've got the green transition, which is ongoing and seems to be kind of happening. 90% of the world's GDP has now signed up for some form of the net zero commitment over the decades ahead. So it kind of looks like that's happening, but it will obviously cost some investment. So that's going to be another kind of critical background reality, I suppose, which is likely to keep energy prices a bit higher. Your question, like, is this just a supply side situation? I think the answer is no. It is impacting demand. We are seeing growth revisions down, particularly in Europe. And on the other side, as it were, inflation clearly a bit higher. So not stagflation, but definitely a stagflationary shock, which is disproportionately hurting Europe right now.
Okay. You mentioned the transition to net zero and how much of the global GDP has signed up to it. How should we think about what's going on at the moment? So if we're reducing exports out of Russia, so imports from Russia, we still need energy. Europe certainly still needs energy. So potentially that will boost fossil fuel output. But does it also boost renewable output? And in 2 or 3 years' time, we might look back and say, actually, the war with Russia and Ukraine, or Russia's invasion of Ukraine, actually helped the shift to renewables because it brought more online. Like, how do we think about it?
I think the current situation of much higher prices is acting as an accelerant for something like pre-existing trends. So the world is moving in the direction of trying to build the energy architecture and infrastructure of the future. I think that's kind of not new, but the urgency around that, unfortunately, has been made clearer over the last several weeks. Yeah, I kind of agree with the gist of your question, which is this is going to see an acceleration, a heightened urgency around, as I say, the investment, which, by the way, is going to take years and decades, right? We don't just solve for this in a few months or quarters. This is going to be a lot of money over a long period of time to build that infrastructure of the future. But yes, I think the current very high commodity prices and the idea that we're perhaps depending on some parts of the world, which is going to become less easy to do over time, I think that is a very urgent current political reality, directly impacting Europe, most obviously. And so we're already seeing European political leaders start to pivot, I guess, a little bit towards some of this, as we call it, the energy infrastructure of the future.
Stay with me, Ben. We'll be back in a minute. My guest this morning is Ben Powell, BlackRock's Chief Investment Strategist for Asia Pacific. Now, look, I was reading an interview with you recently about opportunities for global investors, and you said China's multi-trillion-dollar equity and bond markets opening up is very exciting and unprecedented. Given the geopolitical scene, where are the big opportunities in China?
So a couple of areas, I think. So firstly, just to make the very macro point, China is obviously playing a very different game from the West. So China has moved to a loosening cycle and has adopted, I think, an almost a holistic pro-growth policy set across monetary, fiscal, regulatory, and other areas. So that's kind of, as I say, very different from what we're seeing in the West. So the first thing I'd say is there's a diversification benefit, I think, from where China is in the cycle, and that being very different from the West. A couple of specifics or more specifics. China government bonds by global standards yield a lot. So something like 3%, which by global standards is maybe surprisingly, but that's kind of a really high number. And we're seeing positive nominal yields and positive real yields persist in China government bonds, which again is kind of unusual by global, at least global developed market standards. Related point, I guess, given that backdrop, it's no surprise perhaps that the Chinese currency has been very strong over the last couple or 3 years, something like the strongest currency in the world. So unhedged investments into China government bonds have yielded pretty well and have benefited from that foreign exchange appreciation, which has been pretty strong for the last 2 or 3 years. Coming into equities land, obviously any investment is risky. We are extremely aware that there are kind of multiple headwinds in China, COVID situation, geopolitical tensions, some challenges in property, and many others. So the question for us isn't, is investing in China equities, is it risky or not? Obviously, any investment is inherently risky. The better question we think is, are we being appropriately compensated for that risk? From here, we think the answer is something like yes. So we have a small overweight in China equities. And quite interestingly, just in the last couple of days after the rally we've seen in some China shares, Hang Seng is currently year to date, this can change, but year to date is now actually outperforming both US and European indices, which I guess is some small evidence in that direction of diversification and the benefits of exposure to that still obviously strongly growing, opening up a market, as you were saying.
So on that risk-reward spectrum, are there any particular sectors you like in China or things you don't like?
So a couple of areas, I guess. The big one, I think, is technology. So over the last 12 months, there's been a lot of confusion around the anti-monopoly clampdown and a sense that the regulatory burden is only going one way, which is to say harsher. So I think we've now seen something like the peak in that regulatory clampdown. I want to be really clear. I don't think it's going away. So to extend my metaphor of using peaks, the right peak to think about is Table Mountain in South Africa. So I think we've moved to a kind of a higher level and we're going to stay there. So again, it's not like this regulatory downdraft is going away, but I think it has probably topped out, at least for the moment. So that should give some of the very big companies, some of the technology names, a bit more space to perform. And when you look at them, for example, China tech names, cash as a percentage of market cap, it's like 20%, which is fairly interesting perhaps. But critical to this is this alleviation of the regulatory downdraft, which, as I say, I think we are in the early stages of seeing.
Okay, so let's just leave China. What about other places in the region? Japan, India, South Korea, Indonesia, those sorts of markets?
Yeah, so preference within the region, I guess I'd say a couple of things. Firstly, China, we just touched on. Japan, again, quite interesting. Japan, if anything, is becoming even more dovish, right? So not only is Japan not playing the same game as the Fed, ECB, RBA to a degree, the BOJ, if anything, is even becoming more dovish. So that is quite interesting. Again, very different. And that combined with an opening up that we're seeing both in Japan and globally, Japan's got some fantastic export companies, obviously. And as we see the world kind of continue to open up, Japan should benefit disproportionately. So Japan valuation looks not too bad. Domestic stimulus, not just ongoing, but actually increasing, if anything. And as I mentioned, the kind of very good company gearing into a global reopening, we think is a good spot. In the broader region, I won't go through them all line by line because probably lose the listeners' interest, but I would say kind of the obvious point, but it's important, is thinking about who is resilient to the current inflation shock and who is vulnerable, right? So broadly, Asia is short calories, right? Broadly, Asia is an importer of energy and food. Clearly, with the price surprise that we've seen, the price increase that we've seen, there are some economies that are going to continue to suffer a headwind. Conversely, Australia amongst them, obviously, there are some economies that are much better positioned. So that's kind of another axis how I'd think about splitting Asia, I guess, into those relative winners and losers from the current inflationary backdrop.
Ben, thank you for talking to Fear and Greed.
Thank you.
That was Ben Powell, BlackRock's Chief Investment Strategist for Asia Pacific. This is a Fear and Greed daily interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.